Today, we're going to talk about 4 stocks we're buying, even though they've been affected to varying degrees by Russia's invasion of Ukraine. 2 of those companies are McDonald's and Starbucks. The fast food giant and the coffee king just announced they were temporarily closing their stores in Russia, where they've spent decades working to build up their brands. The 2 others are Philip Morris International, the global leader in tobacco products, and Constellation Brands, one of the world's largest alcohol producers. Companies everywhere have been affected by the conflict in one way or another. But does that mean we stop investing? I don't think so. Hi everybody, Mike Nadell here for the Dividends and Income channel. Before I talk about these 4 high-quality dividend-growing businesses, please do us a favor to help grow our channel, okay? Hit the thumbs up at the bottom of the video, subscribe to our channel, and ring the bell so you get notifications of new videos as we publish them. Look, people are dying, misery is spreading, and the world order is under attack. So I don't want to trivialize the conflict in Eastern Europe by pretending that our stock portfolios are more important than what's going on there. But this is an investing channel. That's why you're watching right now. And facts are facts. And the fact is that Russia's attempt to take over Ukraine also has roiled the stock market. One thing to remember is that eventually, no matter how bad things seem in the moment, the stock market always recovers. LPL Research has come up with an interesting list of how the market reacted to major world events over the decades. For example, the 9/11 attacks resulted in the S&P 500 index falling 4.9% the first day and 11.6% overall. It took 11 days for the index to reach a bottom and 31 days for the market to recover. In other words, a month after that horrific event rocked America, the stock market was back to where it had been before the crisis began. There also were recoveries after World War II, the Cuban Missile Crisis, Iraq's invasion of Kuwait, and so many other terrible events. So I'm not going to stop investing, not for myself, and not as the guy who manages the Income Builder portfolio for this channel. Now let's talk about Philip Morris, Starbucks, McDonald's, and Constellation Brands. Why we bought more shares of these stocks for the IBP, and why they might interest dividend growth investors everywhere. Combined with general market jitters due to inflation, interest rates, the pandemic, and other macro factors, Russia's invasion of Ukraine has led to some pretty big price drops since mid-February. Starbucks, McDonald's, and Philip Morris were down double-digit percentages, and Constellation was off about 8%. But these are still fine companies, so here's an opportunity to buy them at a discount to their normal valuations. Let's start with Philip Morris. They've been the global leader in cigarettes for generations, and Marlboro remains by far the #1 brand in the world. And now, led by its IQOS heated tobacco system, the company also is #1 in non-cigarette nicotine products. In fact, Philip Morris is in the midst of a multi-year transition away from cigarettes, even creating a logo that includes the promise of a smoke-free future. At the recent Consumer Analyst Group of New York conference, Philip Morris renewed its goal of receiving half of the revenues from products other than cigarettes by 2025. Last year, some 29% of net revenues came from smoke-free products, more than twice as much as just 3 years earlier. Philip Morris is the international company that was spun off in 2008 from the corporation now called Altria. Because Altria sells its products in the United States, it isn't affected as much as what's happening in Europe, and its stock actually is up a little over the last few weeks. Analysts at JP Morgan just downgraded Philip Morris from overweight to neutral, saying, "The recent tensions in Ukraine have clouded PMI's ability to achieve its near and medium-term targets, with Russia and Ukraine accounting for 23% of its heated tobacco unit volume. Although the medium-term growth algorithm remains robust, driven by the highly attractive economics of heated tobacco products, external factors will prove too difficult to overcome." Despite all that, though, the same analyst predicted Philip Morris actually will overcome those factors. After all, they assigned a 12-month target price of $110. Indicating that the stock is on sale with about a 20% upside. I'll get more into the valuations of Philip Morris and the other 3 companies in a little bit, but first let's move on to the next stock, Starbucks. I'm not a coffee drinker, but my wife is, and she loves Starbucks. Active in their loyalty program, she treats herself to one of their expensive drinks several times a month. Anecdotes like that, of course, aren't worth much when talking about investing. After all, there are plenty of people who think Starbucks charges too much for their products, or who simply prefer the taste of other brands. So I'll turn it over to Morningstar analyst Sean Dunlop to explain the appeal of Starbucks stock. The firm's attention to premium quality coffee distinguishes it from chain competitors, allowing Starbucks to charge substantially higher prices while creating a buzz around what has historically been a commoditized product. We continue to believe that Starbucks remains a compelling long-term growth at scale story, with our forecast anticipating average top-line growth of 10% through 2026 and adjusted EPS growth averaging 10.8% in our base case scenario. Only a fraction of Starbucks' business comes from Russia, and even Europe doesn't account for a large percentage of sales, only about 5%. But there are concerns that Russia's aggression will cause even higher inflation, especially at the gas pump. It's legitimate to worry that cash-strapped consumers will sacrifice their $7 lattes so they can put fuel in their cars. Starbucks stock had a 501% total return in the 10-year period through the end of 2021, crushing the S&P 500 index. But so far this year, a variety of issues from inflation to the pandemic to unionizing at some stores to commodity prices to a falling overall market and now Russia have conspired to knock almost 28% off Starbucks stock price. Like the coffee they sell, Starbucks stock tends to carry a premium price, so I'm always looking for opportunities to get it at a discount. Next up, let's talk about McDonald's, the world's largest restaurant chain. When it comes to selling burgers, nobody does it better. Mickey D's racked up more annual sales than the next 9 burger chains combined. As a stock, McDonald's was rolling along well into this year, with many analysts raising their target prices after a January 27th earnings call that revealed good news about same-store sales and operating income data. Credit Suisse, for example, lifted its 12-month target to $285, saying, McDonald's defensive, heavily franchised business model, global scale, and healthy franchisees are particularly attractive amidst elevated costs and a challenging operating environment. We like McDonald's strong value position in 2022 and what appears to be increasing competitive behavior, and there is still a recovery story in international markets. At current valuation, we believe McDonald's offers a compelling risk-reward. Once Russia started its saber rattling, though, McDonald's lost steam, and the stock fell some 10% in only 2 weeks' time. McDonald's has spent more than 3 decades carefully building a presence in Russia, where it has 850 outlets and 60,000 employees, and accounts for about 3% of McDonald's system-wide sales. There's also concern that the war will make already significant inflation even worse in Europe, which accounts for about a quarter of the company's sales. But McDonald's is a strong company that will continue to thrive over time. And as was the case with Philip Morris and Starbucks, this is an opportunity to get McDonald's stock quite a bit cheaper. Finally, let's talk about Constellation Brands. Their name might not be as familiar as the first 3 companies we're discussing today, but that doesn't mean Constellation isn't a major consumer player. For one thing, it markets some of the world's most popular beer brands, Corona, Modelo, and Pacifica. Constellation Brands also sells wines and spirits, and it's the number 9 alcoholic beverages company in the world. From the bottom of the coronavirus crash in March of 2020 through mid-February of this year, Constellation stock posted a 130% total return, soundly beating the S&P 500 index. But like other companies we're talking about, Constellation has pulled back recently. It's down about 9% since February 14th. Unlike the others, however, the Russia-Ukraine situation doesn't have all that much to do with the decline, except for the conflict's effect on the overall market. The main issue with Constellation Brands were the reports that they might make a huge offer for Monster Beverage, a leader in the fast-growing energy drink industry. Investors often have negative reactions to potential mega deals because they don't like companies taking on lots of debt. They also worry that it'll be difficult to combine 2 major businesses, especially different ones, like Constellation and Monster. As of now, it's only in the rumor stage, and we'll see if the deal actually happens. I like Constellation's portfolio of brands in the beer, wine, and spirits categories, and I'm glad to buy more of the stock at lower prices. Look, we don't know yet how Russia's war on Ukraine will impact the bottom lines of most companies, including Constellation, Philip Morris, Starbucks, and McDonald's. But we do know that dividend growth investing is a long-term strategy that rewards shareholders of high-quality, proven, income-producing companies over time. We also know that these are 4 wide-moat businesses, meaning they have significant competitive economic advantages over their peers. They score well in other quality-related categories too, with outstanding management and financial strength. As for the Income Builder portfolio buys, on March 7th I divided the $1,000 semi-monthly allocation I get from this channel's owners between the 4 stocks. Now let's talk for a minute about the income these companies produce for the shareholders. Philip Morris, McDonald's, Starbucks, and Constellation Brands have been growing their dividends for years, with McDonald's 46-year streak putting it solidly among the ranks of dividend aristocrats. Philip Morris is by far the highest yielder of the group, at well over 5%. The safety ratings I refer to in that table come from the 1 to 100 scale provided by Simply Safe Dividends. All 4 companies fall into the 61 to 80 range that SSD calls safe, indicating that a dividend cut is unlikely. Philip Morris has become the IBP's second leading income producer. Its $188 in projected annual dividends trail only AbbVie's $195, and the combined $363.50 that the 4 companies are expected to generate represents about 10% of the Income Builder portfolio's total annual income stream. As I mentioned when I was discussing each stock, this recent pullback has made them much more appealing from a valuation standpoint. Most analysts seem to agree, as all of them are now priced at discounts to Morningstar's fair value estimate and to the price targets assigned by various analytical services. Having said that, here's something I can't stress enough. Before you start buying any of these stocks, realize that most of those analyst estimates were put in place before they were able to consider what Russia's attack on Ukraine might do to these companies' earnings, revenue, and margins. So if you're interested in Philip Morris, Starbucks, McDonald's, or Constellation Brands, or for that matter, any stock, please be sure to conduct your own due diligence and to build in a margin of safety when determining the price you're willing to pay. For more information on the Income Builder portfolio, check out the link in the description. Once on our Dividends and Income website, become a subscriber and you'll be notified whenever I write an article about my buys and sells. Alright guys, that's all for today. Again, please give us a thumbs up, subscribe, and ring that notification bell so you don't miss out on any of our content. Take it easy everybody. Back at you soon.